How are borrowing costs recorded with regards to self-constructed and acquired assets, specifically property, plant, and equipment? I'm going to deal here specifically with self-constructed asset, but it also applies to any acquired assets. It may take a long time for an entity to build a self-constructed asset. To finance their construction, entities might have to borrow money, or they might use money they have, which then can't be used for other purposes. Under IFRS, borrowing costs on self-constructed assets must be capitalized. Under what circumstances? First, if the asset requires substantial time to get ready for use. And second, if the borrowing costs are directly attributable. So, what does that mean? Well, substantial time means assets produced over a short period of time don't qualify for interest capitalization. There's no specific definition with regards to substantial time, but it has to be longer than a short period of time. What does that mean? That's for professional judgment. What does directly attributable borrowing costs mean? There's two aspects to this. If a company borrows specifically for the construction, then the interest costs are clearly directly attributable. Obviously, these are going to be capitalized as part of the cost of the asset. However, even if an entity borrows generally, a portion of the general borrowing can be capitalized to the property, plant, and equipment being constructed or acquired. That's because had the entity not constructed the asset, the borrowings could have been used in other ways, such as repaying debt. So, if the entity could have avoided borrowing costs if they had not acquired or constructed the asset, then the borrowing costs are directly attributable and they can be capitalized, even if the loan was not specifically borrowed. So let's go over that again. General borrowings can be capitalized if, had the construction or acquisition not happened, the borrowings would have been used for other purposes. So this is the idea of an opportunity cost. If the entity could have avoided the borrowing costs if they had not acquired or constructed the asset, then the borrowing costs are directly attributable and they can be capitalized.